Wall Street just had its reddest day since Liberation Day. The S&P is down 2.6%, the Nasdaq created more than 4%, and the Dow is down about 700 points. If you woke up this morning and saw your portfolio looking a little bit rough, you're not alone. And more importantly, it's important for us investors to understand why this is happening. Today we're going to break down exactly what happened, why it happened, and some potential next steps about what we can do about it. Welcome to the Mountain Drew YouTube channel, and let's get ready to look into this. And please remember, none of what I'm about to go over is financial advice, and I am not a financial advisor. If you're new to the channel, welcome, and let's take a look into this. The spark for Friday's chaos was actually lit Wednesday night, when Broadcom, one of the biggest names in AI chip making, reported their earnings. The thing is though, the numbers were actually looking pretty good. Revenues up 48% year over year. AI chip revenues up 143% in a single quarter, with record profits all around. So why did the stock fall 13% on Thursday and 8% on Friday? Because often in investing, good isn't always enough. Wall Street has priced Broadcom for perfection. Analysts expected AI chip revenue to be hitting around $17.2 billion, but Broadcom guided for $16 billion. That $1.2 billion gap was unfortunately enough to set a bunch of AI stocks, or a bunch of similar stocks, into freefall. Hock Tan also surprisingly revealed a new strategy shift as well. Broadcom is moving away from selling complete AI systems and will now focus exclusively on custom chips, while at the same time also losing market share to Alphabet and MediaTek, with the main takeaway being when one giant chip company sneezes, the entire market essentially catches a cold. It wasn't just the chips that played a factor into this though. We also recently had access to the May jobs report, with 172,000 jobs added in May, and unemployment staying steady at about 4.3%. That's double what most economists have forecasted. As far as the stock market is concerned, this is a good news, bad news situation. A hot labor market means that the economy is running warm, and a warmer economy gives the Federal Reserve less reason to cut interest rates, which could potentially even cause the Fed to raise rates to keep inflation in check, should they need to. The 10-year benchmark treasury yield jumped about 4.54% on the news, and higher bond yields means that growth stocks become less attractive as a result. Kevin Warsh is currently projecting for one rate cut this year. Growth tech stocks are priced on the assumption that cheap money sticks around, i.e. lots of rate cuts throughout the year. So those rising rate expectations act like a headwind, thus making future earnings worth less in today's dollars. Let's pause here, okay? Let's pause here. Because today's market action looks like a textbook example of a term you're going to hear a lot in finance. And that term is going to be called sector contagion. Let's take a look at what that actually means. Sector contagion is when negative news about one company spreads fear across an entire industry, dragging down stocks that had nothing to do with the original problem. It happens because investors assume that if one major player is struggling, others in the same space likely face the same headwinds, even if that's not yet confirmed. So think of it like if there's a fire in one apartment of a building, the whole floor evacuates, not just that one unit that's in fire. Understanding this will help you make much better decisions during these sell-offs. Sometimes the panic is justified, but more often than not, it's a great opportunity to hop in and buy high-value stocks. The S&P has been on a 9-week winning streak. The Nasdaq is up 10.6% over the year. But most of the growth this year has been primarily fueled by AI. When a rally begins to get that stretched, the expectations that are baked into that rally become almost impossible to meet, which is exactly what we saw happen with Broadcom. Here are 5 things that you can keep in mind as a new investor for the rest of the week. With tip number 1, don't confuse a pullback with a crash. It's important to bear in mind that the S&P is still up about 7.9% over the year, so a couple bad days over a 9-week run isn't really the end of the world here. Tip number 2, make sure to be paying attention to that Fed calendar. The next FOMC meeting is going to be on June 17th. New chairman Kevin Warsh's press conference will set the tone for the rest of the summer. So keep that in mind and pay attention to any hawkish signals, as those could be indicators for a continued sell-off. Number 3, AI valuations remain elevated. Many AI chips and names are still priced for perfection, so bear in mind if you have a very tech-heavy portfolio to maybe take some time to review it and see kind of where your risk tolerance is at. Number 4, we also have Oracle coming up on June 10th as well. Oracle will do their reporting Tuesday after close. Oracle is the next major AI infrastructure data point. How it guides on cloud and AI demand where we set the expectations for the whole sector. And number 5, which is last but certainly not least, make sure to stay diversified. A diversified portfolio is good for cushioning sector-specific shocks. If you aren't already, this is your reminder to consider diversifying across multiple different sectors. If you found this breakdown useful, please like and subscribe. Until then, see you next time.